$1.28 trillion erased from gold and silver markets in 6 hours. Gold dropped nearly 3%. Silver fell over 5%. $280 billion wiped from silver's market capitalization alone. And in the middle of this catastrophic liquidation event, the options market just did something that has never happened before in the recorded history of silver derivatives trading. 30-day implied volatility for silver options is now more than 10 points higher than it was 3 weeks ago when silver was trading at $121 per ounce. Read that again slowly because it defies every conventional understanding of how options markets price risk. The market is pricing more explosive potential movement at $74 than it priced at the all-time high. Convexity and skew both spiked simultaneously. This is not a single anomalous data point that can be dismissed as a glitch. This is coordinated options market behavior signaling something that analysts who have tracked silver derivatives for decades have never seen at this magnitude. While Western paper markets are collapsing, Shanghai physical silver is trading at nearly $100 per ounce. That is a 20% premium above the paper derivative contract traded on the same exchange in the same city, not East versus West arbitrage, physical versus paper on one exchange. The shortage is that severe and that localized and that impossible to explain away with standard supply chain narratives. 8 trading days remain until first notice day on February 27th. March silver open interest sits at 58,770 contracts representing 294 million ounces of paper silver. And here's what should terrify anyone who understands COMEX delivery mechanics. There has been no mass rollover, no panic unwinding. The open interest is completely unmoved with the delivery clock running down. Either the standard rollover pattern has not started, it is being deliberately delayed for strategic reasons, or certain very large players are entirely comfortable holding this size this close to the delivery deadline. When open interest stays this elevated this late in the contract cycle, it stops being routine month-end behavior and starts becoming a genuine liquidity crisis question that the exchange will be forced to answer in 8 days. Before we go any further into what the data is actually showing and why the options market signal is the most important development in precious metals right now, hit that like button if you want analysis that goes to the source documents instead of repeating what financial media tells you to think. Subscribe to this channel and press the notification bell because the next 8 days are going to move fast, and you need to be tracking the data in real time, not reading about it 3 days later in a Reuters article. Share this with anyone holding silver positions or anyone who thinks the 40% correction from the highs means the structural story is over. The people who verify the data independently already understand why that assumption is catastrophically wrong. Now let me show you exactly what is happening and why the next 7 days could rewrite everything you thought you understood about how silver markets actually function under stress. Let us start with the current snapshot because understanding where we are right now contextualizes everything else. Silver Western spot price is at $74. COMEX futures are at $74. Now look at Shanghai. Shanghai spot is at $86. Shanghai futures are at $88. That is a $12 premium that Eastern physical markets are paying above Western paper prices. $12 is not noise. It is not a temporary dislocation caused by holiday trading patterns or currency fluctuations. It is the physical market in the world's largest silver-consuming nation, refusing to accept Western paper pricing as reality. Gold Western spot price just broke decisively below $5,000, sitting at $49.38. The psychological support level failed. Silver is now down 40% from its January peak, above $121. The paper market says crash. The physical market in Asia says something completely different. That $12 gap between East and West is not closing. It is holding firm even as Western paper collapses further. This divergence is the single most important signal in the entire precious metals complex right now, and it is being almost completely ignored by mainstream financial analysis. Now let me explain the implied volatility signal, because this is where the setup becomes genuinely unprecedented. Implied volatility is the market's forward-looking assessment of how much an asset price is expected to move. Higher implied volatility means the options market is pricing greater probability of large price swings in either direction. Under normal market conditions, implied volatility spikes when prices are at peaks, because that is when uncertainty is highest and participants are paying maximum premium for downside protection. When prices crash 40%, Implied volatility typically collapses because the big move already happened and the market assumes things will stabilize. That is the normal pattern observed across every asset class and every market cycle for decades. Silver just broke that pattern completely. 30-day implied volatility on CME silver options is currently more than 10 points higher at $74 than it was at $121 3 weeks ago. The options market is telling you that it expects more explosive price movement from current levels than it expected at the all-time high. This initially appeared so unusual to analysts tracking derivatives data that it looked like a potential reporting error or data glitch. It has now been confirmed as actual market pricing reflecting real positioning by sophisticated players who do not make 10-point volatility bets on reporting errors. The 3 critical dates converging in the next 7 days are not coincidental, and their clustering creates a pressure point that the silver market has not experienced in this exact configuration before. February 20th, SLV options expiry. February 24th, silver futures American-style options expiry, and this is the same day Shanghai reopens after the Lunar New Year closure. February 27th, first notice day when physical delivery obligations begin against the 294 million ounces still sitting in open interest. That 3-day compression window in 7 days is not random. It is a structural configuration where multiple settlement mechanisms, multiple market participant types, and the return of the world's largest physical buyer all converge simultaneously, while open interest sits at levels that would normally have rolled weeks ago. If you understand options mechanics and delivery mechanics, you understand why this setup has the potential to produce outcomes that overwhelm the standard risk management models the exchanges rely on. Let me give you the broader macro context, because what is happening in silver is not happening in isolation. It is happening inside a global financial system that is exhibiting stress signals across every major asset class and every major currency simultaneously. U.S. national debt is officially projected to surge $2.4 trillion per year over the next decade, according to the most recent Congressional Budget Office estimates, total debt reaching $64 trillion by 2036. That is double current levels and triple pre-pandemic levels. Annual interest costs alone are projected to double to $2.1 trillion, and those projections assume 0 recessions across the entire 10-year period, which is a fantasy assumption that no serious economic historian would defend. Meanwhile, every major global currency is simultaneously breaking down to new all-time lows when priced in gold, not just the US dollar. The British pound, the euro, the Japanese yen, the Swiss franc, all of them hitting new lows against gold at the same time. Mainstream financial media frames this as a gold rally story. It is not. It is a coordinated global currency debasement story where gold is simply the measurement unit that cannot be printed. The dollar is the most visible casualty because it is the reserve currency, but the underlying dynamic is affecting every fiat currency on Earth. Nassim Taleb wrote extensively in The Black Swan about how systems that appear stable for extended periods accumulate hidden fragility beneath the surface, then break catastrophically when that accumulated fragility finally expresses itself. The U.S. debt trajectory is not a future problem that policymakers have time to address through reforms. It is a present mathematical reality expressing itself through currency debasement right now. Anyone who reads the primary source budget documents, rather than accepting media narratives about strong economic fundamentals, can verify this independently. Big tech credit default swaps outstanding jumped nearly 400%, from $2.2 billion to $10 billion in just 13 months. A year ago, credit default swap contracts on major technology company debt essentially did not exist in meaningful size. The market was not pricing default risk for these names. Now, the artificial intelligence infrastructure debt binge that created massive leverage across the entire technology sector is being priced for genuine default risk at scale. Bitcoin fell in coordination with equity market weakness. Investor sentiment hit extreme fear levels. Bitcoin ETFs have seen 4 consecutive weeks of outflows. Risk-off is hitting every asset class simultaneously. Equities, crypto, bonds, real estate. That is the exact environment where assets with 0 counterparty risk historically become the final destination for capital, even when they take initial hits during the liquidity flush that precedes the rotation into safety. Here's the industrial reality that no amount of coordinated paper selling can permanently override. Silver is the most electrically conductive element on the periodic table. Modern technological civilization runs on electricity. Every solar panel manufactured requires silver. Every electric vehicle battery management system requires silver. Every artificial intelligence data center packed with server farms requires silver in the circuitry. Every piece of advanced military electronics requires silver with no economically viable substitute available at the scale these industries operate. 1 physical ounce of silver currently costs less than a pair of Nike sneakers. Think about that pricing relationship for a moment. The metal that is irreplaceable in the infrastructure of modern industrial society costs less than mass-produced footwear. That pricing disconnect between fundamental utility and paper market valuation is the direct result of decades of concentrated short selling in the futures markets by a small number of institutions that have been repeatedly fined for manipulation, but continue operating under the same structural incentives that produce the manipulation in the first place. Multiple sources are now reporting that mine CEOs are fielding direct inquiries from major industrial manufacturers wanting to bypass COMEX entirely and arrange physical delivery contracts at substantial premiums. These arrangements reportedly involve hundreds of thousands of ounces per month, at premiums reaching 20% or more above spot price for guaranteed physical delivery outside the exchange system. Samsung has reportedly already executed exactly this type of direct supply arrangement with mining companies. When manufacturers whose production lines literally depend on continuous physical silver supply stop trusting the paper market's ability to deliver metal when needed, they do not write letters to regulators requesting reform. They route around the broken system. That parallel physical market, as it grows larger and involves more tonnage, begins setting price based on actual physical scarcity rather than paper contract creation. The COMEX spot price becomes increasingly irrelevant to the transactions where actual metal changes hands. This is not theoretical. This is happening right now at scale large enough that it is affecting mine production allocation decisions. Iran fired missiles in the Strait of Hormuz today as part of what was officially described as a pre-planned naval drill. The timing is not coincidental. These drills are happening while active U.S.-Iran nuclear negotiations are taking place in Geneva. 20% of global oil supply flows through the Strait of Hormuz daily. Even a pre-planned military demonstration in that specific location, while diplomatic talks are ongoing, sends a calculated geopolitical signal that both sides understand perfectly. Any disruption to energy supply flows, whether from actual conflict or from elevated insurance costs that make tanker transit uneconomical, feeds directly into manufacturing costs, supply chain stress, and industrial silver demand that is already operating with 6 consecutive years of structural deficit beneath current consumption levels. Geopolitical pressure does not just move oil prices. It accelerates institutional capital flight from paper promises toward physical assets when trust in the system is already eroding simultaneously at the monetary level, the debt level, and the derivatives level. The bearish case deserves honest examination because intellectual honesty about risk is what separates analysis from cheerleading. $1.28 trillion wiped from precious metals market capitalization in 6 hours proves conclusively that paper markets retain full power to override physical fundamentals within compressed timeframes regardless of shortage data. Silver down 40% from the January highs is real technical damage that has stopped out leveraged long positions and destroyed the confidence of retail participants who bought near the top. Historical COMEX delivery patterns show that approximately 5% of open interest typically stands for physical delivery, while the rest rolls forward or settles in cash. If that historical pattern holds, most of the 294 million ounces will roll or settle without stressing the physical delivery system. Iranian military drills have historically produced initial fear followed by rapid normalization when no actual supply disruption materializes. The implied volatility spike could resolve quietly if concentrated short sellers successfully reload positions during the Shanghai closure window when Eastern physical buying is temporarily offline. Housing affordability is at its worst level since 2008, signaling genuine economic stress that forces broad-based asset liquidation, including precious metals, regardless of fundamental supply and demand dynamics. But here's what the complete data picture shows when you look at all of it simultaneously rather than selectively. Shanghai physical silver is trading at a 20% premium above the paper contract on the same exchange, while Western paper price collapses. 8 trading days remain until first notice, and open interest is completely unmoved against historical rollover patterns that show mass position reduction well before this point in the contract cycle. Implied volatility is 10 points higher at 74 than it was at 121. The options market is pricing dramatically more explosive potential at current crash levels than it priced at the all-time peak. 3 critical expiry and reopening dates are stacking February 20th through 27th with 0 time buffer between them. Major industrial buyers are routing around COMEX at 20% premiums, with Samsung having already executed direct mine supply arrangements. Every major global currency is simultaneously at new all-time lows against gold. U.S. debt is officially projected to reach $64 trillion with interest costs doubling under baseline assumptions that include 0 recessions. And geopolitical pressure is building on the waterway that handles 20% of global oil supply. These are not separate, unrelated stories. This is one integrated story about a system under simultaneous stress at every major pressure point at the same time. Here is exactly what to watch over the next 7 days. Daily CME open interest updates, which publish free on the CME website every afternoon. If open interest stays elevated into the final 3 to 5 days before February 27th, this configuration stops being routine month-end rollover and becomes a genuine exchange stress test. EFP spreads between COMEX and London, which are the earliest indicator of physical delivery stress in the institutional market before it becomes visible to retail. Shanghai market behavior when it reopens on February 24th. Does the Eastern physical premium widen further beyond the current 20%? Or does it compress as fresh supply becomes available? Whether the Iran situation escalates beyond drill status into actual supply disruption, or whether it de-escalates as diplomatic talks progress. Big tech credit default swap levels as a signal of broader risk-off acceleration that could trigger another coordinated paper market liquidation. Whether the implied volatility signal resolves through a sharp, violent upside move that justifies the elevated pricing, or whether it fades as short sellers successfully rebuild positions during thin trading. Do not take any of this on faith. Pull CME open interest data directly from the CME Group website. It is public, it is free, it is updated daily. Verify Shanghai physical premiums through publicly available exchange reporting data that anyone can access. Read the official Congressional Budget Office debt projections from the primary source documents rather than filtered through media interpretation. Look at currency performance against gold across multiple countries, simultaneously using freely available central bank data. The informed minority who verify sources independently have already done this work. The majority will read the 40% down headline, conclude that the bull market is finished, and move on without ever checking whether the physical market agrees with that assessment. One final question to consider carefully. If paper silver gets sold down 40%, while Shanghai physical simultaneously trades at a 20% premium above its own exchange's paper contract for the same metal in the same city, which of those two prices has an expiration date built into it? The answer to that question determines whether the current setup is the end of the cycle or the setup for the most significant delivery event in modern precious metals history. The data is available, the positioning is visible, the timeline is defined. What happens in the next 8 days will answer the question definitively.